Well, guys, episode 5, we have none other than Phil Williams of Fill the Gap. I'm sure you may be familiar with his face. For those of you who aren't, he is a prolific social media presenter of finance and all things finance, investment, savings, etc. He is an investment professional and he has a social media profile called Fill the Gap. Which is also your business name as well.
Yes.
Some really valuable gems he drops on his profile. So before we even get into it, I want to encourage you guys to go check it out. And he has agreed very graciously to come on the program today to educate us and to give us some knowledge and information on finance as it relates to us personally as well as professionally. So welcome to the show.
And thank you so much for having
No,
me,
thank
Patrice.
you.
I am no. Every time I have the opportunity to share, this is something I don't take lightly.
Yeah.
So I am saying thank you for the opportunity.
You
to
are a
have
rare
Fill the
gem
Gap.
for somebody who has your level of knowledge and experience to want to come on a program like this.
Wow.
To share this information. So I really, really sincerely appreciate you being here. And I think the audience is going to get, value for $9 because it's a free program, but they're going to really get value out of this. So I do want to start with the Fill the Gap profile that you
Sure.
have and why you decided to create the account
Sure.
and use the account to educate people about finance.
Well, I'll tell you how Fill the Gap started. So I've in my line of work, I've been an investment professional for many, many years, right? Since like about 2003. And I have recognized that it really doesn't matter. People from all walks of life have issues. Understanding personal finance can be a bit sticky. It's daunting. And that is how I started when I got opportunities at work to speak to people who knew very little about finance, give them advice. I realized that, I really did enjoy it. So I started doing more of it in my free time, and that then led to Fill the Gap.
What are some of the things as a young person entering the world of work should I be aware of at points in my life?
Well, you definitely, that is an interesting time because you're very excited. It's going to be your first paycheck. It's the first time
Yeah.
you're actually, more than likely it's the first time real money is in your hand,
Yeah.
right? A person who can get an A+ in financial literacy and understand exactly how money works. They understand how the bank works or the markets. They know where to position themselves. They know what to invest in. They know how to save. Should I take a loan now? What's happening with interest rates?
The economic ecosystem.
And right, that's the other thing too.
Yeah.
Very good point. Because when you're financially literate, you understand what's happening in your economy. You don't need to be an economist. And really and truly, we are all economists because we have decisions to make, right? Your decision to get up this morning, position yourself, be about business, handle your stories. That's an economic decision. This is Sunday.
Yeah.
This is on the weekend. This is
Yeah,
free
we're
time.
filming this on a Sunday,
This
guys.
is right. So
Yeah.
what are everybody else doing on a Sunday? I don't know. My parents didn't make poor decisions, right? But there were many other decisions that they could have made. But hindsight is always 2020. But I'm saying when you really think about it, like whether it was like, well, okay, if you invested in some stocks
Yeah.
and you left them for me, 20 years, look at what this could be. That's the difference, because the things that you learn about money, the behaviors that you adopt and how you live your life, you get it from your mom, your dad, your auntie, uncle. That's where you get it. You should get some of it in school, but they're not going to give you that in school. They don't give it in primary school, high school, not even university.
So it kind of comes like your prerogative.
It's something that that's what I said. So you have to recognize this, and I need to get my finances in order. I have a deficiency here. And I want to just kind of rectify that. You see the age that we're living in right now, this information age, but everything is out there. So we could start with it. So if there's YouTube, there's Instagram, there are pages that I'm not going to tell you what to follow, but we do a lot of things on our screen. And maybe you want to start thinking about, well, okay, part of my screen time, I should use this for something to uplift me, benefit me, put me, I might as well. But kids who get that kind of upbringing, they get it from early, they understand. So if you see like a business owner, like when you go in certain groceries and you see they have little kids, they count in, people might look at these people and think they're very simple people, but they're very wise. They move away from the 9 to 5. And there's nothing wrong with a 9 to 5. Because if you can have a steady job and still do very well, right? Or start having a job and then branch off to start your own business.
But I guess it's not, they're not taught a dependency on it then. They see it as an additional or a complementary thing.
Yes. These people working more than 9 to 5.
Countless
They working,
hours,
so when 5 o'clock, you might be home 6 o'clock. They working way into, depending, so they might have some nights way into the night. So it just depends. So they certainly taught about hard work, you have to put in, nothing comes easy.
Yeah.
You apply those principles to finances. You don't look at sacrifices as something that is bad for you. Look at a sacrifice as something that's really great for you. So as a sacrifice is something that is a reward. It's a treat for yourself. It's just not having that treat today. You have to really think about should I save money? Probably more than likely the answer to that is, well, yeah. So the first place you need to be in is thinking about how you're going to save. I like to tell people, listen, if you have $1, try and save 5 cents.
Yeah.
And if you think that there's opportunity to save 10 cents, then that's what you do. And how you actually start saving is really by looking at the expenses that you have
At that point.
and then thinking about how it is, really putting pen to paper and itemize your expenses, writing down a budget. So actually the first line item on your budget should be you. You paying yourself before you pay the grocery, before you pay the light bill, before you lunch dinner. Most people don't do that. So in school, I think if a parent or a guardian, an older brother, older sister, aunt or uncle, kind of imparts this knowledge, where it's not burdensome, but in a way that you really get a kid to understand the importance of saving, they're off to a great start.
Yeah.
Not saying that you don't enjoy yourself, but you could have no savings and I could have savings.
Yeah.
And you're earning way more money than me. And that's just a fact. I'm just stating the stats, right? There are lots of people out there who have really nice things, but they don't have anything safe. They don't have, if an emergency pops up, they're going to find themselves in real problems. And an emergency is just that. An emergency is something that comes out of nowhere that you think is never going to happen because, it's not going to happen until it happens.
Yeah.
And when that happens, where does that leave you? Who are you going to borrow money from? Ideally, what an emergency fund should be is just like 4 to 6 months of your expenses. That takes a little while to build up. So that's like a goal, but you can work towards that over time. It might take 6 months, it might take a year, it might take 2 years, I don't know, but certainly you have money that you're putting aside just for an emergency. It could be something with your car, it could be something at home, it's something just, you never know. It's a big deal if you are disciplined enough to save an extra $100 a month. That is a huge deal because that's going to serve you in good stead. You're talking long term now, right? Because when you really start to now have more money, you're already in the habit of saving. You're in the habit of budgeting.
We're kind of cultivated to operate within a very defined system that was already set for us to enter into versus, as you say, thinking out of the box and being aware of your different alternatives that exist. So for instance, somebody might say, I need a car. And they would automatically think, okay, let me go get a loan to be able to pay for the car versus there might be other alternatives. Okay, how about saving to get to this point? Maybe take a loan for lesser amount. People need to be aware of that instead of just going to the thought go-to.
The bank. So, I will never bash the bank. The banks are there, but you have to understand the bank's business, they have to make profits. So let's be clear on that.
Yeah.
Their duty is not to really, that's not their first mandate. It should be, that's our next conversation, another conversation. So it should be wanting to give you all of the information so that you're making the best decision. They have to sell loans.
Yeah.
Either in the form of a credit card, they're in the business of giving loans, and that's their raw material. That's how they make money. So they're not in the business of educating you and helping you to make smart decisions with the products that they're giving you, right? That's a lot of that responsibility is on us. So I tell you what, house, car, let me talk on the big items. These are the items that have the pull and it's a drain on your resources. So you have income at the end of the month. What you pay out to other people that you don't get to keep for yourself, it's a drain. It's not money that's coming into your wallet. You would be surprised saving up an extra 6 months or saving an extra 12 months and saying, well, okay, probably you don't need to buy a brand new car for $200,000. I could buy a second-hand car for one something. So what people don't see with interest rates is that it might seem small month over month, but if you have if you paying interest over 10, 15, 20, 30 years, it is hundreds of thousands of dollars or tens of thousands of dollars you're talking about that you can potentially save just by making a smart, a wise decision. Of course, you're excited. You get a loan, you get approved, you get the money, you have whatever it is you want to purchase, and you should be excited. What you know you have at the end of when you
It's a
see
payment
is a
fee.
payment.
Yeah.
But you also need to know, to make this a really, really special moment, you should have the ins and outs in terms of what does that schedule look like. Because the loan officer is watching a spreadsheet.
Yeah.
Loan officer knows all your payments, and they don't know that payment is broken into principal and interest.
That's is that the amortization?
It's amortization, correct?
Okay.
Yes, you are wise.
Well, tell
Yes.
the people what the word is so that they know what to ask for next time they
It's
go.
an amortization schedule.
The only reason I know about an amortization schedule is because I took a car loan, and maybe I guess in asking around, somebody told me ask for the amortization schedule.
You can have that information,
Yeah.
right? It's an amortization schedule, which really just outlines payments until the end for the life of the loan. And it's going to break out principal and interest every month,
Yeah.
straight to the end, whether it's a 10, 30, however much years or
Months
the loan
or-
months, it's going to break out each payment. And what you'd realize is if you reduce your principal amount early, it saves you a whole lot of interest. And this particularly too for like big items, like a mortgage,
Right.
a car, any big spend, any big loan. A large amount of that payment in the beginning is really interest. So it's not really a principal coming out.
We did a project and I got some extra money, and I was like, okay, I'm going to put it towards that loan, clear that off one time. And I didn't realize, but it makes sense that what you're saying there, that when I did that, what I did was actually reduce the amount of interest that I would have had to pay, because the interest was spread over a
Yeah.
set period of time.
Yep.
So if I cut off that period and I stop at this point, then I'm really just paying the principal
I
amount
see.
and the very limited interest I would have garnered up to that point. That's what would have been happening.
Yeah, you're paying less interest because your principal is reduced. Now, I'm not telling you to do that and hurt yourself. You're not trying to bend backwards to find, but certainly
Of course not.
once you could, if you have an opportunity to reduce the principal,
Yeah.
sometimes you see how you said there you ran into some extra money. And that's a good example, because sometimes we do. You have to be very specific. If you don't tell the loan officer to
Ahead of.
put this towards your principal, what's going to happen is they're going to put it in some account and they're just going to make the payment every month. What's going to happen? You have to be very specific. Please make a principal payment. Please apply this to my principal. I want to pay down. And that's going to help you, it's going to help me save a whole lot of interest. The sooner you do that in a loan, the better it is for you.
On the topic of loans too, because I want to address the perspective that a lot of people have about loans, right? Some people are advocate for loans, especially large sum amounts, because I've heard the argument that it's better to use the bank's money than your own money. But then we having this conversation about being careful about taking loans, especially if you're on the smaller scale of not making excessive amounts of money. So what is the right balance with that?
So let me, and the right balance suits you. So let me be clear. I will never tell anybody don't take a loan. I've taken loans in the past. And the bank is, let's think about it. If the bank wasn't there, there are lots of things people would not be able to afford. So we need the bank. Let's be clear on that. Bank serves us or society or any economy is necessary. What is also necessary is just you just have a good understanding of how the bank works. There is good debt and there's bad debt.
What is good debt?
Good debt is you taking a loan, understanding how the loan is going to work, because the loan might be your ticket to getting achieving these big financial dreams that you have.
Right.
A loan is a really great thing if it's a loan to do something that benefits you. So if you're taking a loan to start a business,
Right.
you're taking a
That you
loan
know is gonna
that you
make
know
back
is
money
gonna
for you.
it's gonna generate capital. You're gonna one, you know how you're paying on the loan, and two, you know what this loan is going to get for you. Not that something just fleet is a liability, right? You're taking a loan for your education, to better yourself. To that's an option too. Or you take it from schools are taught on that in terms of, but here some of our education is subsidized, and around the world that could vary. So naturally you want to take that opportunity to see, you seize those opportunities certainly. But if you don't have them available to you, what you going to do? And it doesn't necessarily have to be tertiary level education. Something, because it's a course or
some program,
something
yeah.
that's maybe if you can't afford it, you might have to take a loan for that. That's a good loan.
Yeah.
That's good debt. Right?
Because you're
If you-
investing in yourself,
Right?
basically.
If you know your long-term goal is to purchase a house, whether it is or land, you take a loan, and you can manage the loan. You could service the debt. You can service the payments. In the long run, you have an asset, right? or something that you can convert into, to cash. Because some people say, okay, I know the whole theory that your house is not an asset because, your house takes money from you, which is true. Your house doesn't put money into your pocket. Plus you have more than likely you have a mortgage to pay, you have fees or whatever. But a time will come when the house will be an asset. A time will come when the house will, or it may not be an asset for you, but you might gift this house to somebody. So it certainly is an asset for them. So now you're talking about your legacy. That's what you're leaving behind. So most times credit card debt is bad debt.
Right.
If you cannot pay your credit card and you are ramping it up, now I understand if you say, listen, some people you might really end up in a, so let's say you do have an emergency fund and emergency pops up. Well, oh God, you have no choice. You have to use your credit card.
Right.
And you probably, hopefully, that is an opportunity to say, well, maybe, that might jolt you into to start to save for the emergency fund. But if you just using your credit card to do the most, to be about that life, to be that you that can't go on for long.
Yeah.
That's not sustainable. And that's a general principle with debt. Credit card, it's the same. That's a real expensive loan. That's really what a credit card is. It's an expensive loan.
The other day when I went to get information about a mortgage, for instance, the first question they asked was, okay, do you have any loans? I'm like, no. Do you have a credit card? I'm like, yeah, but there's no balance on your credit card. I paid on time. It was like, no, but we still have to factor in the fact that you have a credit card and put that as an expense or consider that as part of an expense. And I'm like, you can't win in this situation, boy. So not even knowing that when I applied for a credit card for the convenience of that is something I need to be aware of as well when it comes to my credits status moving forward with any other decisions that I have to make. That's something I recently learned.
They just want to know if you can pay, you good fit. You're going to pay them back their money. And part of doing that is determining how much debt you have. So the credit card might be free because you don't have, but that doesn't change. You might ramp up that tomorrow. You could max out your credit card tomorrow. So they're going to say, well, okay, this is stuff we need to know, and we're just going to apply it because they want to check and see what your debt service ratio is like, what capacity you have to service the debt that you're going to take from them, that money. It's just, that's all it is.
Yeah.
You would hear some people say, listen, don't get a credit card, cut up your credit card, and that's one school of thought, and that's not bad advice. But sometimes it's not practical, it's not realistic. And then there's some people who are very disciplined. They will take their card, but they have cash, but they just use the card to get the points. Whether it's miles, whether it's something, and that is how a card can benefit you. So you use it to your advantage. If you know you don't have that discipline,
don't.
No, a credit card can hurt you badly. A credit card could hurt you. It's all, much of it is a thief head,
Yeah.
First of all, you think the money is yours. You think it's yours. So you have an entitlement to it. And you just spend more when you have a credit card on you. If you're hanging out by the bar and you had cash in your pocket, you would spend the cash you had in your pocket.
What you have there, right.
If you have a credit card, you will more than likely buy a wrong sphere. I'm not telling you to be selfish. I'm saying, but your chances are you're going to spend more if you have a credit card with you. And again, if you know, well, okay, you have the cash to take care of that, fine. But if you know you're in a situation where you're trying to save money because you're working towards the school, and every little thing counts, you might think $100 is nothing, but if you're saving $100 every month, extra, like just you find an extra $100 that you could save, or $200 that you could save, you do that every month, it adds up. Adds up to the end of the year. Christmas time, you could do something with that, the $100 that you thought was nothing in January, when in December you have $1,200 or $2,400 that you can do something else at Christmas. You can buy a gift, you could buy paint, instead of taking your credit card to ramp up, or taking a loan for Christmas, or taking a loan to do things at these times that, that's part of our, I don't want to say it's part of our culture. I think Trinidad is not the only place that people do that, but I know Christmas is a big deal here.
Yeah.
Carnival is a big deal. And for some people, to pay down on a costume beforehand, that's an emergency.
Yeah.
So they might go into the emergency funds. That's an emergency. It had to happen, right? You can't
Right.
tell you can't
That's
tell
your
me.
vice. You can't let that
can't
go.
tell you. You trying to tell me that I can't. So that's that mindset. Again, I'm not knocking it, but when you really think about it, when you dissect that, if you take a step back and say, well, boy, I mean, that money is not yours.
Well,
It's not
it's
yours.
good that
It's
you're
the bank's money, and they're going to come back.
comfort.
They're
Yeah.
going to come back and they're going to say, "Here, what's happening?"
It's good that you emphasize that, because I have friends who I would say, if you are not disciplined with your finances, try not to get, even if you get a credit card just for the convenience of being able to buy stuff online or whatever, try not to get a high limit credit card, because you are going to run yourself into rail. And not only that, I know I'm a tedious person, right? I'm a very tenacious person. I could sit behind my laptop and look at the spreadsheets of how I spend my money, and make sure that I'm checking back the due dates of the credit card and up to par with that. That's me. Not everybody is like that. So if you know you are not that type of personality, don't put yourself in a
don't put
situation
yourself
to
out
have to
there.
run
Don't
into
put
this,
yourself,
you know.
Don't put yourself out there.
Yeah.
I know what I'm going to tell you. Don't get excited if you open your email or you get a phone call saying you want.
Oh, yeah.
So the natural be like, boy, you know, I get a call, boy.
Yeah,
you know, I
we
get
see
an email.
you could afford a credit
You know,
card. Would you like
want
one?
you want to increase your limit. You know, that's a status symbol for
Yeah.
somebody. You know, when you think about it, and I understand why you could think it's a status symbol, but it's not.
Yeah.
You know, it's not. And I'm not saying that to be, it just is, it's not. And that is the, it's playing on your mind, it's on your psyche.
In
so
fact,
that,
they might probably have targeted you because they realize they can't make money from
of
you.
course, well, of course. Of course. So they say, you know, you qualify for this loan. So, really? You can increase your limit. And that's, I mean, as I said, they're in the
they get
business of
catch.
selling, they are in the business of selling loans. I tell you this, there are only 3 ways. Well, I mean, we could talk about many other ways, but 3, like the basic ways to accumulate wealth. That's your own business. That's investing in stocks or real estate or a combination thereof. Or unless you are sufficiently advanced in a company where you impact the decision making, so you might be a senior executive or en route to being a senior executive. So, you know, in a sense, you have a vested interest in this company. You might even have shares in the company. So you're still 9 to 5, but you're in a much more, you're in a role to make change happen and get and then with that monthly, you know, that salary or that income, you can do a lot. You could probably invest and buy real estate, and but at the end of the day, it's your own business. It's stocks, it's real estate. You know, and I know the conversation about investing, as I said when I told you earlier, you know, when you're thinking about finance and personal finance, people go straight complicated. Well, I want to invest and I want to get money, and what are these returns?
Yeah, short-term fix.
The real conversation is in the behaviors. What am I doing every day? Or what am I saving? What is my budget like? What is, you know, how is the simple things that you actually do have control over? Because when you get to the complicated things with investing, you don't have control over the markets, because you can invest in a great company, but the economic cycle, like we see what's happening right now, the pandemic hit a lot of companies. Doesn't mean that they're bad companies. It means that this is the part that they fit in the economic cycle, and you know, that's what happens when you're investing in stocks. You know, it's kind of up and down. So investing, which I know a lot of people, and you should be thinking about, I like to tell people, like anything, investing is not a get rich quick overnight. It's not it's not a scheme, a get rich quick scheme. It's not, it's certainly not that. Definitely it's not. It takes discipline, it takes dedication, and it takes time, but you're gonna get there. And the sooner you wrap your mind around, like, this is not gonna happen overnight, because when you do things, if you are taking that kind of risk because you think you're going to get rich overnight, you can lose everything.
Right.
That kind of risk is, you know, you lose everything pretty much. Versus being very consistent and dedicated and disciplined, and you get there over 5-10 years versus, and the thing about it is, before you know it, 5 years will creep up on you.
Yeah.
And you spend a whole 5 years trying to get rich quick in 5 years, but you lose plenty or just didn't work out, versus being very steady on a month-by-month basis.
Yeah.
Basic financial instruments. So if we're talking investing, there's stocks, there are bonds. Basic, that real plain vanilla. So there's a bond. You invest in bonds. The best way to describe this is if with you and I,
Right.
if I came to you and I said, listen, I want a loan. A loan is like a bond, and the person that's taking the loan or is issuing the bond has to pay
Right.
interest. So if I was issuing a bond, it means the bondholder gets interest, and we're talking big numbers here now. So like a government of Trinidad and Tobago bond. Let's say the government, so sometime earlier this year, they issued a $500 million US bond. And they're going to come to the market with. So the government is the issuer. They are borrowing from investors, like
Right.
people, big financial institutions in the market, all of like the big banks and big investment houses will invest in that government bond, and the government now has to pay these investment companies interest, and they pass it on to whoever participates, whether it's a unit holder or shareholder or whatever.
Right.
Stocks is, if I said, well, listen, I need some money, but I'll really give you ownership in the company. So I'll have to pay you back like the loan, but what I'll pay you is you get a chance to participate in the profits that we make in the
Long
business.
term.
And if the stock price appreciates, that's what they call capital gain. So if it's stocks, it's dividends
Okay.
and capital appreciation. Stocks, your potential, your earning potential is a lot higher than with a bond. A bond is like, I know I have to pay back, Patrice, this is the agreement, it's interest, it's safer. But if it's stocks, the potential, you mightn't get the earnings one time because the business is now starting, but the long-term potential could be great.
Right.
So you can earn, or it could be not so great.
Right.
So it depends. Those are the two ways that you can invest. It's also the two ways that a business raises capital and gets money to do what they want to do. So on a very simple level, for an entrepreneur, it will be the same mechanics. Either they're taking a loan from someone, could be mommy, daddy, or the bank, or whoever, or they're giving someone ownership in the business to get this injection of cash to advance the business, but the person has ownership and now has a right to a portion of the profits that's generated. Most investment products, it could be an insurance policy, it could be a mutual fund.
Mutual fund is different from stocks and bonds?
So a mutual fund is like a basket of stocks and bonds.
Okay.
So a mutual fund, you have a mutual fund will now, there's a portfolio manager who will go and scan and look and say, look what region of the world you want to invest, and then look at the sectors, so whether it's the tech sector or the finance sector or healthcare sector, and then say, well, okay, I want to invest in these companies, and they pool it together on behalf of the investors, and then they pay them from the same mechanics that I described. And they have different kinds of funds which are geared towards different kinds of goals. So remember we spoke about stocks and bonds.
Bonds, right.
They're exchange traded funds and mutual funds that invest just in bonds. They're exchange traded funds and mutual funds that invest just in equities and stocks. And then there are balanced funds, mutual funds or ETFs that invest in both bonds and stocks.
I actually was going to ask about ETFs as well, because I saw you mention that on one of your posts.
Very good. You're paying attention to Philly Gap. Look
Philly
at that.
Gap is
Wow.
a crucial source of valuable information, guys.
I
You need to
like
check
that.
it
I
out.
like that. Okay. So ETF is an exchange traded fund. So a mutual fund is not traded on a stock exchange. So ETF is similar to a mutual fund. It's like a basket, similar basket of stocks, but it's just traded on an exchange. So you don't have to walk into, say, a mutual fund to actually purchase ETF. You could buy it on an exchange, but to go out to purchase an ETF on a stock exchange, you need to have a brokerage account. And I do know that there are local financial players here that actually provide that service through brokers for their clients.
Right.
Many of our local banks here in Trinidad provide brokerage services. So I'm sure pretty certain whichever bank you bank with, they do have a brokerage service. And that's why it's good for you to figure out, when you're choosing a money manager, what is on the company, what's their track record has been, how long they've been in business, who is actually managing the money,
Right.
who are making these decisions to invest in these companies and these bonds, so that I get the best possible return. So that's how investors could get money. Granted, the past is not always
An indicator of the future.
I know but it's the truth.
Yeah.
But
Past
it sure gives you a decent gauge to make an informed decision.
Yeah.
And it is as basic as that. If you wanted to open a brokerage account, you will go into the brokerage company and say, hi, my name's Patrice, and I'd like to open an account.
I could just, as a normal off-the-street person,
and you can, of course, the regular person, right? Anybody.
So who are the people that are aware of this section of
people who ask questions,
right?
The people who want to know, the people who are interested in investing. It's not just for rich people. It's not just for people who have degrees in finance and economics and have
It's for the person who know to walk in
it's
and
for the
ask.
person who wants to take charge of their life and wants to have a put themselves on a path to achieve particular goals.
Which I actually wanted to have you differentiate or identify the difference between savings and investments.
Okay, very important to distinguish between what saving is and investing. Saving is basically putting your money somewhere, but it's not working for you. So you can save, but it's something with money that so your emergency money, you could save, you could put it somewhere where it's, because you need to access it, right?
Yeah.
You don't really need that money working for you, because getting your money to work for you means making an investment, which means there's the possibility that it could fluctuate. You don't have control about how over exactly the path that money takes. You know the money is going to go up once you made a good investment, but you don't know the path, So saving is one, parking your money. Investing is your money actually working for you, putting it into an asset that is going to generate income, that's going to get, gains for you.
Where would you advise, or where should people ideally put their savings? In a bank, in a credit union? Like, what are the best spaces or avenues to facilitate that?
I would say income fund in any one of those, any mutual fund, an income fund. So just to recap, an income fund invests in bonds and short-term financing instruments that pay interest, and the interest is passed on to you. So you want to save somewhere where you can get the best return, but obviously somewhere where, if it's particularly, like, say if it's an emergency fund, somewhere where you have access to it, but you get a decent return. So you say, and you get the least amount of charges. So you don't want any charges.
Right.
You want somewhere where you have little to zero charges, access, and a decent rate.
Yeah, the access thing is important, especially
For
because
emergency, particularly.
So, for instance, with the credit union, if you put most of your money in shares, I think if you want to withdraw that, you have to wait, like, request it in writing, and then wait a period of time.
The credit union is different, so you're right. Good point you made there. There's some credit unions. I mean, the credit union is certainly not a bad option, because you get, from what I have heard, higher rates on fixed deposits, higher rates, and they can charge higher rates than what a typical mutual fund would charge, because they're lending money, and so they can pay slightly higher returns.
Right.
So a credit union is not necessarily a bad option. What I would caution anybody, they're credit unions and they're credit unions.
Right.
Right?
Yeah.
They're in Trinidad and Tobago, there's some really stellar, they're really good credit unions. It's not difficult to start a credit union. So you want to know, you want to do a little background check if you know you're thinking about saving in a credit union. You find one of the better ones, that's a great option, particularly if you know the money is there for, like, long term. If you know you're saving the money there, you have it there for 3-5 years, you're going to get a better rate. But certainly, money that you need in the next 6 months, next year, next 2 years, next 3 years, an income fund.
Right.
That invests in bonds and short-term financing instruments, and you get a decent return and you have access to it. That's where you want to save.
So for long-term savings, for instance, a young person trying to save for a house, what is the best?
Right. So some of that money, so long-term savings now, then we shifting into somewhere, because long-term and saving, here's how I'm going to dissect
gets into
that.
the investment area.
Yeah, because now we're thinking, when I think long-term, I'm thinking investing. So I'm not thinking about saving. Saving is very short-term.
Okay.
Or something that something that you need. So you might have money saved for a long time for emergency, but the emergency never happened until a long, long time. But sure enough, it could happen many times. So that's money that you just need to get to. You don't want to be saving too much of your money there, because you want your money growing. You want to have the right mix in terms of, so long term now, what you want to invest in. Remember, I spoke about mutual funds.
Right.
Anything past 3 years, that's where the house that you're saving for, you want to invest in stocks, because your earning potential is higher and you have an opportunity for dividends and capital gains if the stock price increases. That's where you want to put your long money. And if you're saying that, I'm not so risky, but I'm more moderate and I want a decent blend, so I will invest in stocks and bonds, because usually what happens when stocks are not performing well, bonds perform well. So that's why it should balance out.
Right.
And when bonds are not performing well, the stocks perform well. It just depends. Well, might not, there are a lot of crazy things happening in the market right now, but that's a different conversation.
Yeah.
But you want to invest, and particularly too when you're a lot younger, in a product that gives you growth. And I like to kind of break it up as, if you're 20 years old, then and you have $1, 80 cents of that dollar should be going into something long, stocks, 80 cents.
And you
20
find
cents.
ways how do you find the entity or the avenue?
Same
to-
thing. So the
It's-
same banks that I told you that have brokerage services, they also
Go to
have
those
mutual.
banks,
They
right.
have mutual funds. So not just the banks, but financial institutions. They're different. A lot of the financial institutions have
These features or
have
facilities.
have mutual funds,
Right.
But the largest mutual fund provider, let's start there, in Trinidad and Tobago, is Unit Trust Corporation, and it was the 1st, and then many of the financial institutions started to mimic, and they have that business model and started to do that kind of business. But the very first mutual fund and investment company in Trinidad and Tobago is Unit Trust, but there are also other companies that provide that service as well. So if it's a starting point, is just probably see.
Go for
You
mutual
go
funds,
see what's
research.
happening with see what mutual fund is appropriate for you. As I said, I can tell you take more risk when you are younger,
Right.
and start reducing that risk as you
makes
get
sense.
older, because time now you have less time,
Yeah.
basically. So that's where you do with the long-term goals.
Right.
You have to position towards stocks versus bonds. Short term, you're more fixed income on the bond side. That's how you don't save more than you need to save. The savings goal could be because you want to buy something at the end of the year. It could be for Christmas. I mean, I know we're close to, but like if you started doing that in January, you had a savings goal. Yeah, you save that in an income fund. You save that in an account that access,
Yeah.
push the button, you get it, push the buttons, you get it, and the least amount of charges and the best possible rate that you can get. That's how you have to kind of split your goals too. So you have some goals that may be short term.
Yeah.
The long ones, you can't be saving for a long-term goal in a short-term account. That's not, you're hurting yourself.
Right.
And there is such a thing as having too much savings. Too much savings means that you have too much cash sitting idle, doing nothing when you can put it to work for you. Because if you're not going to touch it, then you should just have it working for you.
Right.
Right? You don't want to have too much cash just sitting idle or earning not as much as it should be earning for you.
I think at the end of this, people are probably going to want to know if this is a service you personally provide, or how do they get into contact or access with somebody like yourself who has that level of experience to guide them.
Most of the times, the first conversation with me is always pro bono. It's always free because
Yeah.
it might be very basic advice, which I can't charge people for that.
Yeah,
Right? That's not
just to know the
so. It's
basics.
not so. Usually, people send me DMs. They send me a direct message and
Yeah.
they say, can you call me? Or they send them, can I call you? And I call them, or they call me and have a
Yeah.
conversation. And then from there, we see what is needed.
That's really awesome that, as I said, that you're so passionate about the topic and making sure that people are aware of the best decisions they should make for themselves, that you make a service like this available, and easy access to. The fact that you put this content on your social media for free.
Interesting you say that. People are where they are but when people need to find it, they find it because somebody will tell them, listen, because people, everybody's doing what they're doing, right?
Yeah.
So I put it out there with the hope that they see it in the time that they're supposed to see it,
Yeah.
or somebody sees it and then they could give them that advice. That's why I do it. I want to say thank you again as well.
You're very
gracious
welcome.
with those compliments. I appreciate that. And thanks for having me here today. I
Definitely,
appreciate
and
that.
I really would want you to come back and continue to share your knowledge and
I will.
information. And you guys go check him out on social media. It's
Fill the Gap TT.
is it there
Yeah.
social? So there's Instagram, Facebook
and
website.
Twitter. Yeah, and on our website, yeah.
Right, yeah, and and you can check him out there for his contact details and direct message him. He's very active on social media and will be able to answer your questions as they come along. So thank you guys for staying all the way to the end to get all this valuable information, and I hope you continue to watch us here on Business One-on-One, the video podcast series that's being brought to you to help edify and raise your standard of information related to finance, business, admin, all the operational areas of your potential success.